All right. Well, thank you so much, everyone, for joining. Again, my name is Brian Boughner with Parallel Financial and Lakeview Capital. This is our call today where we're going to take a look at over the next year, 2015, and just give you our outlook on a few things here. Again, if you have any questions, we will have a Q&A time at the end for that. But let's go ahead and get started. The call will probably last about 20 minutes here, a presentation, and then we'll have leave plenty of time for questions at the end. Okay? As we get started, we said this last month, and I'll go ahead and repeat it again, but we're going to be looking a lot at markets that are traded, things like stocks and bonds and commodities, because traded markets tend to be forward-looking. Okay, economic numbers are always backward-looking. So when you get, like this morning, we are going to talk a little bit about the unemployment report that just came out, and again, but that's reporting on what happened last month and the month before. So economic numbers always tell you what happened. Markets that are traded are telling you what's happening going forward. And so we tend to put a little more stock into what those markets are telling us, because it really gives us a good idea on what's happening. And so we'll start today with this chart here. It's the S&P 500. And let's do this. There we go. That's the orange line. The blue line are the assets on the Fed's balance sheet. Okay, and so this goes all the way back to the low here in 2009. And you probably heard us say this before. As the Fed has been doing this thing that you read about in the papers called quantitative easing, meaning they're printing money and buying assets and injecting that money into the economy. You hear us say into the system, the banking system, the money system. It's been a positive for stocks, and you can see. When the blue line has been rising, when the Fed's been increasing its balance sheet, the stock market has gone up. When they have paused, we've seen these corrections. And then, of course, early 2008, they increased it. Market went up. They paused. We had a little bit of a correction here. Then they entered here in 2012. This was called Operation Twist. I won't get into the details of it, but they were essentially selling some of their short-term securities, buying long-term. It was somewhat positive the market. And then beginning in 2013, they started the mother of all quantitative easing programs, and they increased their balance sheet dramatically, and then the market's gone up with it. Well, as we know, that has ended. So we are now going to go to a period where they're not going to be growing their balance sheet anymore, and it remains to be seen yet what is going to happen with stocks. If history proves as a guide, we could potentially see some corrections, but that may or may not happen. History doesn't often repeat, but sometimes it rhymes. At this point, the stocks are still showing some healthy buying, healthy demand and supply figures. So, it's something that is certainly on our radar that we're watching. But for now, the Fed's going to hold tight. They're not going to buy any more assets. And so we're closely watching how the market will respond to it. Let's just flip back here real quick. One of the reasons why this has been positive for the market is as the Fed is buying these assets, what they're trying to do is keep interest rates low, okay? And so who has been really benefiting from that are large companies, which, of course, make up the S&P 500. Because what these companies can do now is they can go to the debt markets and they can issue debt at very, very low interest rates. So as you see here, if we look at corporate debt issuance, and this is going back to 2001, 2001, and this is in billions, so 776 billion, and then that number was kind of steady, and then 2006 into the top of 2007, that number began to grow. Then we had the recession, 2008, 2009, it dropped. But if you notice, right in line here, from 2009 to 2013, well, really 2008 to 2013, we've seen corporate debt issuance double. And sure enough, if we go back to the previous slide, this is pretty much this picture here. Because interest rates are so low, companies can go out and issue tons of debt at super low rates. And what they can do with that debt, and we'll see in the next slide, is they can, they can use it to invest in new plants. They can hire people. They can, grow their business. But what they typically have been doing is they've been buying back their shares, or they've been raising dividends. So they've been taking that money in and doing things to support their stock price. Unfortunately, it's not what we would say is a long-term solution. Yeah, these are short-term things you can do to prop stock prices up. These are short things you can do to keep your shares moving higher, but it's not a long-term solution to growing your business. I do have 2014 on here, and if the fourth quarter numbers have not been reported and verified yet, but if they come in as expected, last year will be even a higher year than 2013. This next slide here goes to what I just said. This red and green line, what it is, it's an index of companies that have been aggressive buyers of their shares. And the blue line is the S&P 500. So if you go back to the low in 2009, companies that have been aggressively buying back their shares have been doing better than the S&P 500. This is just some seasonality numbers that we like to look at. So this goes back to 1942 and then basically gives you the average return for each month. And if you notice here, December was a strong month. We had a good month in November, had a great month in December. January typically is a strong month. I think we're slightly positive for the year after the strong move yesterday. We've gone a little bit, of course, next month is not necessarily a great month either. A lot of times you'll hear sell-in may go away. It's because, typically the beginning of the year and the end of the year tend to be positive, and then kind of May through October, November, you experience either some flat or down months. It's not always the case, but just something that we look at. So for the month of January, we certainly have seasonality on our side here. That being said, another thing that has got our on our radar right now is what we would consider a bit of a risk-off move. So, when we evaluate things, are investors embracing risk or are investors running away from risk? If they're embracing risk, then what they're doing is, they're moving out the risk curve. They're taking some risky bets. They're willing to accept some risk. When the risk off, they're pulling their money in. We like to say it's a flight to quality. So money is just going to go into safe things just to keep it safe. And one of the things we do to measure that is we measure the spread, okay, the difference between certain bond indexes compared to treasuries. Because ultimately, a U.S. government bond is probably the safest thing that you can own. So, if you want to park your money somewhere that's liquid, that's safe, you'll buy U.S. bonds because you can get your money back anytime you want, and the U.S. government's not going away anytime soon. As these spreads narrow, okay, what happens is people are buying. In this case, this is a corporate master index. So these are just a big index of corporate bonds. So as these spreads narrow, it means money's either coming out of treasuries into corporate bonds or moving into riskier investments necessarily than treasuries. When the spread widens, in this case, and that's what we're seeing right now. So this orange line are corporate bonds, the black line is U.S. Treasuries, and then we're just simply measuring the difference between the two. And if you notice here, the spreads widened a lot back in 2011. This was the Euro debt crisis, so there was a big flight to quality then, and then really since then, they've narrowed. Well, what are we starting to see now is we're starting to see these spreads widen a little bit. And what we like to say here is that the bond market tends to be, quote unquote, the smart money, and the stock market not necessarily. So sometimes the bond market can act a little bit as a predictor of maybe some potential disruptions in stocks. Again, it's not to say stocks are going to go into a bear market or anything like that. It's just right now today there seems to be a flight to quality, and so what we do is we just put this on our radar and take a good look at it. I mean, stocks are still moving higher. There's still money flowing into there. So it's not that we sell all our stocks and put our money under our mattress. It's just that right now we just want to make sure that that things are we're just a bit cautious. Talking about interest rates in general and treasuries, this is the 10-year treasury going all the way back to the 40s, and you can see from the 40s right into the 80s you had this big move up in interest rates, and then really we've been in a 30-year downtrend in interest rates. And one of the reasons why we've been saying for a while now we don't think interest rates are moving higher is because we're still in this downtrend. We've not seen a move up yet that would justify to us that interest rates are moving higher. The other thing that I think people don't realize, if you look here, November 30th, 1942, 10-year Treasury was 2.14%. On June, or here we go, on July 31st, 1954, it was 2.31%. Okay, that's a 12-year period where interest rates stayed pretty darn low. Okay, and so I think, people think, well, interest rates are either going to go lower or they're going to go higher, but I think what a lot of people aren't realizing is interest rates could actually stay low for a while. And that's something that you don't hear a lot about in the news. You hear that they're going to go up or they're going to go down, but what we are saying here is no, they probably could stay lower and just kind of stay in this range a lot longer than people think. And so, because of that, we are, we're not running away from bonds. We do own some fixed income because we believe that interest rates will probably stay low here for the foreseeable future. And a big reason behind that, and I'll actually flip ahead a couple slides here, and then I'll come back, is because inflation is pretty much non-existent right now. In most developed markets. So here's the annual inflation rate for some developed markets. Here's the change from last month, the short-term interest rate in those markets, and then the 10-year interest rate. And you can see, most of Europe, which is dominated here, inflation is practically nothing. In some cases, there's actually deflation going on. Here's the United States, 1.32, change from last month. Inflation is not a big issue right now. So when we think about interest rates moving higher, well, when you have very low inflation, it's not necessarily a huge need for interest rates necessarily to move up. Of course, some of the areas that have high interest rates, Russia, we're very familiar with some of the problems going on over there. Brazil, they have high inflation, but sure enough, they also have pretty high interest rates as well. So let me flip back a couple slides here because I want to talk a little bit about fixed income. So we think interest rates are going to stay low. The yield curve, where we measure the difference between short-term rates to long-term rates, has really flattened. So the Fed, right, is keeping this target rate down here near zero. And if we look a year ago, which was this orange line, we had what was called a steep yield curve, meaning, when you think about interest rates on treasuries from 3 months, 3 years, 5 years, 10 years, you expect the interest rate to be higher. Well, if you notice from a year ago, they have dropped considerably. So interest rates have really come down, and we call this a flattening of the yield curve. And if the Fed starts to raise rates at the end of this year, short-term rates, which they very well may do, this yield curve could potentially get even flatter, especially if there's no inflationary concerns in the economy. So yield curve is flattening. Let's go to the next slide here. Now, and it looks like it cut off the top of the slide here, which I apologize for that. But what this does is this looks at a historical ranges in yield and then where we're at today. So if we look at, it even looks at the S&P, the dividend yield on the S&P 500. It looks at U.S. corporates, treasuries, municipals, high yield, and then emerging market and global debt. And as you can see here, if this is the historical yield range where like U.S. corporates have, yielded between about 9% all the way down to maybe 2%, treasuries between 1 and change up to about maybe 6-7%, historical ranges here. You can see across the board we're at the very low end of those ranges. So that being said, yes, we think inflation is going to stay low. Yes, we think interest rates are going to stay low, probably in the foreseeable future. But now is not the time, and we caution clients all the time, now is not the time to chase yield. Now is not the time you really want to be going out and trying to get as much yield as you can on a fixed income investment because we're already at these low ranges. So when you think about, looking down the road 5 years from now, 10 years from now, the reality is that the chances of these yields moving higher are we would say would probably be greater looking down the road than necessarily going lower because we're already at these low areas. So buying a lot of fixed income, long-term fixed income and debt could potentially be a problem going forward. So we would just caution folks and say, you want to, owning fixed income here today is fine, but just be careful because we're at the low end of all these ranges here. The chances of that earning a significant amount of return necessarily from that would be very limited. All right, we talked about inflation, really lack of inflation and deflation around the world. This morning, the employment report came out, and I want to talk a little bit about that because unemployment actually dropped, which is a great thing, but the surprise that hit everybody was that wages dropped. There was supposed to be an increase in wages, and there was actually a decrease in average wages. So that has shocked the markets just a little bit here, and we think the reason for that is, again, if you look, this yellow line is total non-farm payrolls, and throughout the 80s and 90s into 2000, it was increasing. Of course, we had the that recession tech bubble burst in 2000, then it increased into 2007, and then we had the big drop here 2008. But as you can see, non-farm payrolls has been rising, and we're at all-time highs. The problem with that, though, is the labor force participation rate has been dropping. So this is the amount of people that are participating in the labor force has gone from, even as high as 66% down to, slightly below 63% here recently. And it's a pretty significant drop, and that's why we feel that, you've got more and more people working, but wages are dropping, and usually that doesn't happen, right? The more people you have working, so the less pool that you have of unemployed people to draw from, you're going to have to now raise wages to try to attract workers to come work for you, and we're seeing the opposite happening right now. So, so we think a good part of the reason why the unemployment numbers are dropping is because less and less people are participating in the labor force, and again, because we have very low inflation here, that's another reason why you're not seeing this big move up for wages, and that could potentially be an issue here, in our economy, because 67 or whatever 68% of our economy is consumption, consumer driven. The good news is we've had a drop in oil prices, gas prices, which we'll talk about here in just a second. The bad news is wages are still not going up the way that we'd like to see. So, we're just going to go through a few charts here. I'll comment real quickly. Again, we're not in an inflationary environment. Usually you want to own gold when either your currency is going down or you're in an inflationary environment. None of that is happening right now. So gold is dropping, continues to stay here in a multi-year downtrend here from the top back in 2011. The price of copper has been in a downtrend since 2010. Why is copper important? Because it's in everything that we own, right? It's in our cars, our houses, our electronics. So when you think about when things are being made, there's a huge demand, it's going to drive copper prices up. We've seen copper prices go down. Interesting, the red line here that I have along with it is a chart of the emerging markets. So that's, Brazil, China, India, Russia, those places. And as you can see, it is, for the most part here, there's been a little separation here recently. It has also tracked the price of copper as well. Oil, of course, we know oil has dropped, and so this has been a positive here so far for the economy, right? Because in essence, it acts a little bit like a tax cut in the sense that we're paying a lot less at the pump. We are of the belief we've got to be careful, though. Really super low oil prices will actually come back and have a negative effect. I was reading in the Wall Street Journal this morning. There's a steel plant that they're thinking about shutting down and laying off about 700 workers because they were basically supporting the oil industry here in the United States. So if oil gets too low and some of these wells start shutting down, well, there's going to be some ripple effects in our economy as well. So what we don't want super high oil, we don't want super low oil. What we want is kind of a sustainable price where it's affordable at the pump, but yet it also keeps people employed in the industry as well. We're of the belief that range is probably somewhere here in this $60 to $80 range. So we wouldn't be surprised if oil starts to find a bottom somewhere in here and we see a move back up. It's funny. So it's not funny, but I'm seeing reports now $20 oil and things like that. I can rewind back 5-6 years in 2008 when oil was at $140 a barrel, and I was reading all these reports about $200+ a barrel. Of course, that never happened. So, usually when these reports start coming out and you start seeing these ridiculous prices, in our opinion, we're getting somewhat near a bottom in oil prices. The dollar has been on a big rise. It's no coincidence that as the oil prices have dropped, and really it's been dropping due to supply, just way too many countries, way too many folks are pumping oil right now. At the same time, though, kind of the perfect storm, the dollar has been rising, and oil is priced in dollars. So it's really kind of a double whammy. You have a huge glut of supply, and you have an increase in the dollar. Oil prices are dropping. That's one of the reasons why they've dropped so much. And this gets back to what I was mentioning about a risk off. You know, what's been driving this dollar higher is, you know, is there's deflationary concerns around the world, as you know, some of these economies are stagnant right now. A lot of money is pouring into the United States. You know, it's the best house in a bad neighborhood scenario, and it's driven dollar prices higher. A rising dollar is not necessarily a bad thing. You know, all throughout the 90s, our economy did great, and the dollar moved higher. But a sharp spike up in the dollar can be negative, especially if you're, you know, if you own a company and you're making widgets in the United States and you're shipping them out around the world. Well, now all of a sudden your widgets are now more expensive because of the price of the dollar. So again, we don't, you know, strengthening dollar is good, but a really sharp spike like this, if it continues, could have some negative effects. Again, we think this could potentially, you know, run out of a little steam here, and we could see some correction going on there. So here's what we're watching for 2015, and you know, one of the things, and I meant to say this at the beginning, and I apologize for not doing it, is that, you know, when we give our outlook, one of the things that we don't do here is we're not trying to predict where the markets might go. We're not going to say, you know, we're not going to give you price targets of where we think the S&P or interest rates might be. What we simply do is we simply evaluate where we're at today, and then make sure we're positioned around that, and then come up with a list of things we want to watch for, you know, kind of a checklist as the year goes on. Because, you know, and just for sake of time, I won't go through it. I know we've written a few blog posts about it, but you know, these people that come out and try to predict the next year on what they think is going to happen, 9 times out of 10, they're completely wrong. So, you know, in our opinion, it's just a fool's exercise to do that. What we're trying to do is let's analyze what's going on today, and then let's try to set a set a criteria up of things we want to look for. And this is what we've got here for 2015. We really are watching the actions of the Federal Reserve and the world central banks, what they're saying, what they're doing. You know, that was the first chart I showed you, was the Fed. You know, with the quantitative easing. A lot of these central banks right now, I think Europe is about to kick off their big quantitative easing program right now. So we're watching that and to see how the markets respond to that. We talked about inflation, deflation. So a big thing we're going to look at in these world markets right now is whether deflation kind of stabilizes. Deflation is bad, by the way, especially for stocks. So we want to see this stabilize, or if it begins to intensify, you know, we'll need to watch that as well. We just talked about the U.S. dollar and you know, potential devaluation, because, you know, keep in mind, if the U.S. dollar is going up the way it is, and I'll just go back to this slide right here. This is comparing the U.S. dollar to a basket of securities around the world. So if this is going up, then those currencies are being devalued. And again, you know, it's okay to have kind of a steady trend, but when you have these spikes, it can destabilize things. So we're keeping an eye on there. And, you know, right now you want to be investments that tend to do well with a rising dollar. Price of oil we talked a little bit about. We need that to stabilize. And then as I mentioned earlier, whether the market has risk off or risk on characteristics. You know, risk off, you know, we need to be positioned then, you know, kind of, I like to say we need to hunker down a little bit, get a little more defensive. Risk on characteristics, you know, that's where you stick your neck out a little bit and increase your appetite for risk. So these are the 5 things that, based on what we're seeing right now, that we are watching and that we're positioning around. So I'll go ahead and end the recording here. Let me do that now.